I live? I think the answer is yes, right? All right. So today, what happened? Everything cheaper. Why is that? Let's just take a quick look here. Thank you for joining. It's not quite a shocking day, actually. And that's the reason for today is, I usually will say something like, we need to fire up the stream on the same day. But today was quite extraordinary. And I'm running behind on preparation, so I'm going to babble a little bit. But let's just take a quick look here. Yeah.
There's been a story that I've heard now a couple of times. The Swiss, we pointed out, raising rates. Do you know the Swiss National Bank owned $177 billion in U.S. stocks? Yeah, including a lot of tech stocks.
Oh my God, they're like Tiger Global.
No, I don't, they changed their language on a potential currency intervention.
Hey, David,
They dropped the one-sided commitment to guard against currency depreciation, right? The Swiss have been very focused on keeping the franc strong, but there is, and we won't know, but there is a question as to whether or not the Swiss National Bank, with that $177 billion in U.S. stock, may now proceed to start to sell some to keep the Swiss franc stronger.
Holy cow.
Okay. Please subscribe to the Substack. Okay. For persons who have been here during this period, right? For people who have been here, you've known I use this, cliche, by my own design, right? Stocks for show, bonds for dough. And the point is the principle that while everyone loves to talk about the numerator, right? You love to talk about the numerator, earnings per share. My company's better than their company. I've got these competitive products versus the landscape. All of which, by the way, has fed to you from an entire complex who's built to sell you stocks, to sell you asset accumulation, right? The entirety. That's the entire industry. The issue is that, of course, the denominator is not well understood. It is much, much bigger. It is controlled by central banks, the Federal Reserve, the single most important party in financial markets, period. Right? That, of course, has counterparts in other countries. Bank of Japan, People's Bank of China, European Central Bank. This morning, overnight, apparently, not confirmed, Swiss National Bank. That the source of these funds is so big and their holdings, right? They don't care a lick about the numerator. That's not their mandate. Their mandate is to pay their people. That's it. And job number 2 is don't forget job number 1. And from there, you can see it, which is simply what happened today, apparently. Right? Apparently, we're going to say the following. Let's just see if I can get us to the spot that I wanted to. I will get us there, I promise. The issue is I can't show us, like I said, I'm running slightly behind. All right, let's just do it this way. So up here, going to be showing up on your screen in just a moment, is what I'm going to show you is I'm going to show you, come on you. That's meta careful. I'll get you out of there in just a moment. Here is the S&P 500. So this is the futures market. It trades 24/7 basically, right? For all intents and purposes. And I woke up at my normal 5 a.m. And what I found instead was this here. This right here. And more important, actually, that's actually not right, is it? Here it is. So this was yesterday through the end of the day. You can see it, 15/6, right? June 15th. The Fed spoke, up we went. Somehow, somewhere in here, 4 o'clock in the morning, while we were sleeping, you saw tremendous down. This is how many? 100 S&P handles, 2.5% in what? 2 hours. And that's what this video is about. Is that it would have had to be someone huge, right? It wouldn't have dropped that way in U.S. markets on U.S. stocks.
There's been a story that I've heard now a couple of times. You know, the Swiss, we pointed out, raising rates. Do you know the Swiss National Bank owned 177 billion in U.S. stocks? Yeah, including a lot of tech stocks.
Oh my God, they're like Tiger Global.
No, I don't. You know, they changed their language on a potential currency intervention.
Hey, David, that's...
They dropped the one-sided commitment to guard against currency depreciation, right? The Swiss have been very focused on keeping the franc strong, but there is...
That's the last thing we want to hear. Is on top of this, right? On top of the idea that we have very little understanding generally. The investing public doesn't, the American public, and don't get me wrong, anyone other than professionals in financial markets, and I'm not talking about your Edward Jones broker. I don't know anybody Edward Jones. I don't know anyone from Adam. When I'm talking about your retail stockbroker, retail financial advisor, that's not what I'm talking about as the professional market. It isn't. Sorry. Okay. As a person who has delivered speeches to central bankers, I'm just telling you that the amount of dilution and different factors that the professional market is talking about compared to Snapchat as a buy at $13 a share we're not even talking about the same topic. And I'm sorry if you're going to say, okay, Jay, that's awfully condescending. That's just a fact. The size of the capital involved here, the agendas that they are dealing with here, they don't care a lick about Snapchat, whether it's $13 a share or $15 a share. They don't care. What they care about is their pensioners. What they care about is their asset allocation. And if they've decided, right, and they've got, of course, in that, the thing when I say stocks for show, bonds for dough, I left out one phrase, which is, that phrase is, and foreign exchange is laughing at all of them as single A ball at best. Meaning the entirety of the country's sovereignty has to do with foreign exchange. The entirety, its essence, exists on as foreign exchange. If your currency runs out of control, you cease to be a country, right? Your citizens are immediately impoverished. You can see this in Latin America. You've seen it in Africa, right? Hyperinflation, and those are extreme examples. I get it. Nevertheless, what we've had here and sitting in the newsletter has been the statement multiple times on multiple occasions to say, not, yeah, I'll show you something big. So my point has been, right, that has been literally the reason that I started the separate newsletter for Jay's Corner. Literally the reason is because I had noticed, I have known this process, of course, I've known this process, but I've noticed, in addition to that, the dysfunction, the relationships of stocks, bonds, foreign exchange was pretty messed up pretty much a little bit more than a year ago. GameStop, AMC, you can remember. My point here is that, the world is not built, or the investing world is not built for this kind of variability of interest rates. And you can see, look at this from here. And you can see we are from where in March, 1.5%. Do I even have it right? Nope. Yeah. You can see harrowing 1% here, July of 2021, 3.25%. To that degree, the denominator here has changed. To that degree, the denominator here has changed. That's down here. And that's of the government as the borrower, not Jay's Rib Shack, which is a company that, sells ribs on the corner. Okay. Jay's Rib Shack, my borrowing rate has skyrocketed. Why? Because I'm not the U.S. government. I'm not the U.S. government. So, of course, as a result, my borrowing rate is nowhere near where the U.S. government is. And you're just going to give me a second here. I need to go to my other computer just for a quick moment. Okay. So let's continue. Because in addition to, as I've said, interest rates here have been unnaturally or notably too volatile. And given the fact that every price of every financial asset, it doesn't matter. This can be your rent to, own to rent home. It's the same. Right? You can't get away from this basic principle. When you look at the denominator and how volatile it is, yeah, well, as I don't like the saying, but, hold my beer. You ain't seen nothing yet until you see the absolute biggest market, which dwarfs the bond market, which in turn dwarfs the stock market. The third largest economy in the world. During that same period that interest rates were 1%, by the way, you've gone from 103, you can see 103, to 130. Basically, if you had 100 yen, you had $1, right? You now have 70 cents. At the same time that inflation has gone up. So now you had a candy bar, it was $1, right? It's now $1.10. And in yen terms, it's another 30% on top of that. To that degree, the idea of Japanese touring inside the United States now, well, there aren't that many to start, but it's really unlikely now, right? And oh yeah, by the way, yes, of course there can be some, you know, to them money is no object. So let's not get nuts, right? Um, let's just see here. Am I even broadcasting? I don't know. I do not know. Ah, I am. Thank goodness. Okay. If countries are going to be concerned about this as their primary priority, this can be the basis of how, you know, historically war has started, literally, right? Conflicts about this type of economic superiority, one versus the other, is that dramatic. Economic warfare certainly is waged here in foreign exchange. Economic warfare is waged here, and there's a book called Currency War, James Rickard, which is basically that. Right? That in fact countries have been manipulating or attempting to manipulate their currency in order to gain a economic competitive edge, which is also why the competitive Edge of Nations by Michael Porter. That book is trash, by the way. Terrible, awful book. Because it doesn't deal with this. It's like incredible. Anyway, you can see it here, and you'll see other locations. The euro. So we've got too short a time frame here. Yeah. From 122 down to 105. And we've got this same pattern here. So we've got a mess. We have a mess. Because what we've done, basically, is while the first thought has always been on this, the first thought has been that, look, interest rates have moved around here and don't fully explain why different parts of of equities have worked relative to each other in that way. And when that happened, that was the reason that, you know, the radar turned on. I started to, you know, bang on pots and pans to say, look, this is odd. This is weird. Something's up here. Something is not quite right. And what can happen is that, you know, during that period of unrest, what ends up happening is, I'm going to tell you how Wall Street works. I'm going to tell you how broker dealers work. Is they're not running directional books. They're not running like, oh, we love the U.S. stock market or we hate the Japanese stock market. No, that's not what happens. They're looking at them compared to one another, and they're rebalancing all the time, around the clock. Around the clock. They are not just going in isolation. Oh, well, you know, I love the S&P 500 or I love QQQ. No. No way. Right? Oh, well, it's cheap at $14. No. Stop. That is not how institutional money works. That's certainly not how the broker-dealer community works at all. And this is why I'm saying you can hear the disconnect between this and the research report saying Snapchat enterprise value. It's completely irrelevant. Not completely irrelevant. I'm just saying that it really had to do, it presumed it presumed full stability and knowledge of where R was, the denominator. None of that works anymore. Period. That's it. So before somebody said, well, this stock is cheap or that stock, there are other bigger picture matters. And now, this video that I started here.
There's been a story that I've heard now a couple of times. You know, the Swiss, we pointed out, raising rates. Do you know the Swiss National Bank owned 177 billion in U.S. stocks? Yeah, including a lot of tech stocks.
Oh my God, they're like Tiger Global.
No, I don't. You know, they changed their language on a potential currency intervention.
Hey, David,
They dropped the one-sided commitment to guard against currency depreciation. Right, the Swiss have been very focused on keeping the franc strong, but there is, and we won't know, but there is a question as to whether or not the Swiss National Bank, with that 177 billion in U.S. stock, may not proceed to start to sell some to keep the Swiss franc stronger.
Holy cow. Okay, so let's say that.
By the way, don't know.
No,
but I've heard it now from 3 separate people this morning asking the question.
No, but what's interesting is that the stocks that got hit the hardest between 4 and 5 a.m.
Were
fine.
They were.
Banging a couple semis.
I mean,
but isn't that the most obvious?
Take a look at the Swiss National Bank's 13F.
Look at the ones you isolated, the ones that are most visible. Yeah. If you're not selling Carvana if you're from, you didn't buy.
No,
you didn't buy Airbnb.
No, they own a lot of Apple.
This is what they own.
Yeah, it is.
David, that makes so much sense.
Don't know if it's again. But the idea would be that you're actually selling to make sure you keep the franc stronger.
Well, they sell whatever they have, right?
But I don't know. I'm not sure what's going on, Jim.
See, Carl, when I was watching the sell-off, and I said to myself, okay, so they're not selling Walmart.
But by the way, by raising rates, you're already your currency is you're helping your currency. So it's not clear to me exactly.
Look, you can't solve the supply problem. Jay Powell's not going to be drilling, or he's not opening a refinery. You can stop the demand. You can cause layoffs.
Right.
Listen what you just said, like recession. Now, I had a company, now this is where David's really going to hate me, but I'm going with it anyway, right?
Go with it.
I had a company called Dutch Bros.
Oh, yeah, of course.
Just don't.
The Annihilator. You had the Annihilator.
Yeah. No, there we go. That's what Powell's targeting.
It was
collateral damage. Is that what people want? He can't. He can't. And
quarter.
What are they using for first
Apple,
quarter numbers?
Microsoft, Amazon, Tesla.
Bad time. Let's admit it. 13 months. And then
quarter.
What kind of?
Right?
But Greenspan took rates from 3 to 6.
I'm playing around here a bit because I got
12,
too many
13 months.
trying to
Right.
Do the internet Qualcomm? They're really crushing Qualcomm.
There you go.
Yep.
So
they got rid of their view that they would only intervene in a one-sided way and said the currency was fairly valued and they were open to selling. So I don't know. We don't know, but we're trying to figure out.
Solve the puzzle. Those were the stocks that were getting hit.
Right.
Do the internet Qualcomm? They're really crushing Qualcomm.
I don't know that they own any Qualcomm. Let's see.
They weren't selling MasterCard. They weren't selling any of that. David's got the sell program list.
There it is, Qualcomm. Yeah,
Okay.
it was fairly valued and they were open to selling. So I don't know. So their first top
David
holding.
is just talking about,
Here we go.
12, 13 months. And then the market took off,
Here it is.
right? It took off.
Look at the Swiss National Bank 13F.
Yeah.
Their largest holding is Apple. They own $12 billion. They own $12 billion worth of Apple at the end of the first quarter.
What are they using for
Okay, it's not
Apple,
worth 12 billion at the
Microsoft,
end.
Amazon,
No.
Tesla, and Alphabet.
Oh my God, they don't.
And Meta and Nvidia. Those are their first top
Okay,
7
so
holdings.
David is just talking about I watched that tape very closely. That's exactly what they.
So the point here is lots of points. We have more than 35 minutes of points just to make on this alone. Number one, the Swiss National Bank is not going to be sending out a memo, right? They're not sending out a memo. They're not going to execute a loan, right? But they're not they're not going onto Thinkorswim and hit sell. That's not what's going to happen. That said, they're also not going to be telegraphing it and saying we've got 10 billion of stock to sell. Please place your bid. There will be other parties involved, no question, who will be keeping it under wraps until it occurs. But it needs to execute. That's how it works. Now, why did I start the broadcast? Because this is a new variable that we've not seen. This is something new that would dramatically change the way this picture could work. The number of different scenarios. And I did allude to it, right? In other words, without trying to have a crystal ball, without trying to say, here's what I think is going to happen. Because I'm instead, number one, there's nothing in stone where, okay, well, even if I thought that something would happen, that means that there's a 1 minus that percent that other things would happen. That's where the point of this graph is. Shout out to Steve from South Carolina, who correctly, in our very first phone conversation, said, I've run simulations for manufacturing, and what you're describing sounds something like, hurricane forecasting. Well, as people know who've read the Substack, there's a picture, one of the titles was Sacre Bleu about Hurricane Henri a year ago. That something new changes, the direction changes, and sometimes it's so big that you then have to take it into consideration. It is one that has existed, but has existed maybe way out in one of these tails, and we would have assigned it a very, very low likelihood. Well, today, all of a sudden, that one get thrust more towards the middle, more towards the average, more towards the one we have to consider. Yeah, I don't think there's any question about that. Even the likelihood that it's true is noteworthy. That's how big, right? You are talking about the possibility of central banks changing their allocation of stocks and bonds for their own agenda, which have nothing to do. I can't stress this enough. I'm sure you're tired of it. It has nothing to do at all with the numerator. That has nothing to do with it here. The way that they'll be able to impact it is through the denominator, because currency, the cost of currency is the cost of what? R. R is the cost of capital of holding one currency versus another. This is why there's no arbitrage in interest rates and foreign exchange. Right? Because the glue here is R. The glue here is R. Before we get too deep into that weeds, just look up purchasing power parity. Purchasing power parity. It will draw you the relationship between foreign exchange and interest rates. My point here is, if now all of a sudden central banks are going to be involved in reallocating, or even that be a probability in order to deal with this, right? That they don't, let's say, for example, and there are many scenarios. I could tell you a very easy scenario. Very easy. If the yen is so weak that nobody wants to do any business and receive yen, then what? And like I said, this is the way that countries fall apart. This is the way literally the societies fall apart. What was it? Venezuela. right? Zimbabwe. You know, why? Hyperinflation leads to massive devaluation of their currency. And now all of a sudden it's not worth the paper that it's printed on. And now the country basically ceases. And while we are, of course, nowhere near that, to someone who had thought that their Snickers bar was 100 yen and now all of a sudden is 132 yen, it matters. Right? It matters. It matters. Because that's now no longer a Snickers bar. Right? That is waging now, and don't get me wrong, within certain levels, this is waged in multiple directions. Right? Because while on one hand, the country may not want 132 necessarily, Toyota probably likes it. Remember that. Toyota probably likes it because all of a sudden, the cost of building a Camry is a lot lower in dollar terms, or a lot lower in yen terms, and then they get to sell their Camrys in the United States for X dollars and convert back to way more yen at home. It's that big. It's that unsaid. And it's not unsaid. It's not said by the entire complex, which is telling you, you know, the S&P 500 is cheap at 16 times earnings. Or, you know, I like growth versus value. The reason that now you could say, okay, well, these guys don't matter. That's can't be furthest from the truth, right? And the simple analogy, and I think we're going to stop here, right, at the end. The reason it matters, of course, is let's just say that you live in a subdivision, and in that subdivision is the richest person in town. The richest person in town. Now, for some reason, let's say he's broken a regulation at his work, and he faces a huge fine. So much so, he can no longer afford to pay for the mortgage on his house. Okay, what does he have to do? Well, you got to sell, right? And so now he's sold as a forced seller, not because he wanted to, but because he had to. You're the next door neighbor. Okay? And you borrowed on home equity line of credit, based on a certain valuation for your home. And now all of a sudden, because your neighbor's problem, the bank comes and says, you know, your house is not worth 100 anymore. It's now worth 80. The cost of your home equity loan is now no longer X. It's now 1.2X. What happens? Well, very simply, right? You've got to pony up the 1.2. Whereas before it was 1. What did you do? Oh, I owned Apple from $70 a share. Okay, well, Apple's too cheap at $130 a share. Did it matter to you? It didn't matter to this person here who has had to pay this fine due to violation of regulations, right? It didn't matter to him. He had to sell. And now, so do you have to sell. And now it becomes undone. And by the way, this is the common thread you can run through every financial crisis, has to do with some breakdown here in lending. And when that occurs, what happens is people can't run diversified portfolios. right? They don't get to buy X percent of stocks versus Y percent of bonds. That no longer is a viable solution. They can no longer run this portfolio. For example, here it is on your screen, I hope. Yes, it is. So this is the Vanguard Retirement Fund. This is the fund that I do show to people on an ongoing basis. This isn't the dumb guy in the room. I don't need to tell you that, right? This is before today, and tomorrow morning when I pull this up, it'll be notably lower than 20%. This is this year so far. What ends up happening is if this breaks down here, if we have a further breakdown here as a result of foreign exchange, you may not even the best of class can have even a worse time here. Because, and you can see also, for example, so this is BlackRock's, the same fund, basically. Targeted Retirement Fund of 2040. Minus 18.08. Minus 19. This one is actually updated correctly. This one is lagging. Yep, this is a day long. I was wondering, they're not going to be this far off. I promise you this, right? Which is that tomorrow when BlackRock, it's going to look basically like 19.7%. I've literally seen it as 0.01% different on a year-to-date basis this year, even with the volatility. My point is that the smart guys in the room are creating frameworks. They're creating frameworks, and then they're allocating assets across asset classes. Right? There is no other method by which to do this. Shout out to Steve from South Carolina again. Because with his background, which didn't have to do with finance, but had to do with testing of particular manufacturing processes, and then trying to see, okay, about reliability. How different is that than this in reality? It's not. And this is why Jay's Corner, right? As I told him, I tell this to other people. Like, I largely consider my function here on Jay's Corner Medicare, health insurance, annuity, life insurance, long-term care rider, you name it, is to think about the cost today here at the red arrow, at the tip of the red arrow, and across the different scenarios, what your payouts will look like, what they will be, what they will not be. And yeah, somebody tries to say and brag to me, well, I ran a Monte Carlo simulation. I get it, and there's nothing to say that a Monte Carlo simulation is wrong, but it's a fanciful way of what I'm showing to you in practical, usable terms here, so that you can understand. We don't need to use terms like Monte Carlo simulation. How about we just say, guess what? A hurricane can switch course, and you've got to switch course along with it because some fact may have fundamentally changed, which would change the possible path of the hurricane from that point, which is the tip of the red arrow. Today, a very notable video here at the beginning. Very notable. We cannot get, I'll leave a link. I made a video short. I'll put that link here. That was this morning. Now, last thing I'll say about today is the following. Let me see if I can pull this up here. I will do it. So, I'm pretty sure this violates most stuff that I'm supposed to do, according to my well, I'm not charging you for this, right? No, I'm not charging. By not charging you, what I mean is I'm not charging admission for this. So this is my YouTube TV. So let's just see. What we're gonna see here is, to make it worse today, even worse.
Avoid the term the economy a recession.
Moreover, sold 70 basis points on
its target rate by 75 basis points. That is the most aggressive increase in 28 years. Major averages rallying across the board in response, but finishing well off, off session highs. The S&P up almost 1.5%. The Dow added over 300 points, both snapping 5-day losing streaks. The tech-heavy NASDAQ led the way, up more than 2.5%. Meantime, the bond market taking a breather despite the rate hike. Yields on the 10-year Treasury pulling back a day after touching an 11-year high. So was the Fed able to get it right? Guy.
Well, in terms of the communication, Mel, I think they got it right. Absolutely. We had a pretty robust conversation on Monday, and then Steve came in and his reporting suggested.
So this is yesterday's
exactly
fast
this.
money.
And I think across
Yesterday.
the desk, we said this is what's necessary. And I know Tim said it, and we talked about it earlier today. The market will probably rally on the back of that. And
Ding. So it was not. The very first thing I said when I came on today was that I would have expected 80%. In other words, given yesterday, given the reaction to a new set of facts from a rate increase, given the way the world reacted, I would have said today wouldn't have been just a normal, right, a normal distribution day. I wouldn't have called the likelihood of up and down 50-50 in the same symmetric way. I would have called it heavily skewed to higher without a crystal ball. And again, today's not financial advice like it says. And not only that, since I don't have a crystal ball, and the reason I always say this is that even if I'm 80%, even if I thought it were 80%, that doesn't prevent the 20% from occurring. Let's continue on.
And I'll say this, given the selling we've seen over the last, obviously, month or so, given that it's gotten to a lot of our price targets, the S&P, I would submit that given the language we heard and given the setup, this market can rally probably another 7 or 8% from here.
This is a professional, right, with lots of experience. You can see him on other locations. What was it called? There's another channel he has. And the fact of the matter is that I don't think that this was an uncommon sentiment. And while I wouldn't have been able to pin down or no, he's there for hot takes as well, right? So as a result, shout out to him. He gets this role. That said, would I have shouted out, X% or Y%? Nah. I would have just said higher or low. I said skewed to the higher. That's what I said the first thing today. That person particularly agrees, as well as one of the other colleagues. Nevertheless, very shocking overnight that something that dramatic actually, instead what we got, and this is part of it, right? This is an important component of this, which is it's not only, right? It is not only that it was this far down, right? Do we have this right in terms of the time frame? It's been a rough, yep. Here it is, middle of the night. 5-hour time span. This is the candle of the European session. Right here. You can see everything smooth up to there, and all of a sudden, what was said 24 hours ago invalidated entirely plus some. Last point. All throughout the press, is going to be this thing of, well, in the long run, X. Don't check your portfolio holdings, Y. You know, yada, 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 yada. All right. Okay, I'm going to pause it to you now. Right? That sounds attractive. Maybe that sounds attractive to you, compelling to you. Right? And granted, I can understand all that. Right? Historical average, since we don't know, we need to rely on history, etc. Right? That kind of stuff. Right? Fine. Your 100 cents on the dollar is now 80. So it cost you 20 cents, 20% here for not paying attention or considering whether or not whether your framework of understanding has been right at all from the beginning. And unfortunately, what I'm telling you is maybe is that unfortunately? If you're under the idea that ignorance is bliss, then this is unfortunate fact that I'm here in front of you. That is true. Why? Because that entire set of information flow to you is on the numerator. It is built to tell you about the numerator so that you can deposit money there and keep it there. This, not coincidentally, those same persons saying annuities are bad, life insurance retirement plan is bad, etc., etc. They're motivated to tell you that they're expert in the numerator, when in fact it's the denominator, which is far bigger, which people gloss over because the denominator has just been this stable. If you have questions, you can send them to tell how terrible I am at marketing. I only have my email to send over here. There's phone call. You can leave your comments below. Be sure the Substack, subscribe to the Substack, this channel. We'll get back to Medicare in due course here, but these moves pretty dramatic under very fragile situation. I can understand that causing quite a bit of distress. I think that people are going to be forced to change their retirement plan, their retirement timing, their framework by not have gone through these steps. But instead by being blindsided. I don't think there's any question about that. Not at this point. Not at minus 20%. Minus 5%, maybe it'd be fine for you, right? Already retired, minus 20, I put it this way, the very, very well off wouldn't got there by not letting it get to this spot, right? No chance, right? The persons who have been ignorantly bliss, even they would have to be paying attention now. We don't have it, because not only that, and I keep saying this is the last point, but this one really will be. If you understand how I'm trying, the terms and conditions, the way I'm trying, the framework of understanding, in order to make back from 80 to 100, it has to go up by 25% from here. If I thought through this lattice and through any type of tree diagram, how do we get to plus 25%? Without a crystal ball, that now is probably fairly unlikely, which means we're going to need more time. And during that time, not run into expenses, not running into one-off costs, not running into, hidden taxes, etc. That's why all the pieces have to fit together well. With 10 minutes to go, and we can go on to NBA Game 6. I never miss playoff games. Never miss playoff games. I can barely dribble, but missing a playoff game